Buddy, I'll try to face this way. All right, I'm Michael Jimenez. I am co-founder of Xchange.loans, which is the online marketplace to buy and sell loans. And y'all are joining me for Note Camp 2020. Thank you, Scott, for having me, for inviting me, for seeking me out on LinkedIn. I don't know who got in touch with who first, but it was great chatting with you. Where's this? Oh, here you are.
You know what it is?
I don't know if you guys can tell. I have a lot of screens.
You're golden. What we'll do, Mike, is why don't we'll leave the questions to the very end, and that way we'll ask questions from the people, because I know you got different screens versus seeing who's got what. So I'll let you go through this and kind of moderate. If I see something, I'll jump in, but otherwise, I'll jump off the video here, so it's you and everybody sees just you, and we'll go from there.
I'll try to. Yes, that works great, Scott. Thank you. I'll go by your lead. I was watching this weekend, and I changed this up literally just to based on what you guys are presenting and sort of where I saw like you guys need help the most, or just need information. I shouldn't say help, because I'm probably I learned a lot from you guys this week too. At any point, Scott, please interrupt me. I tend to ramble. But this is it. How to source, present, and close commercial notes. We're going to start off real easy for Note Camp 2020 here. Again, I'm Michael Jimenez with Xchange.loans, this is going to be, I forgot to mention that. So this is like the first public, I guess, or even private viewing of our new, basically what we've been working on, which I'll save to the end if you guys want to see it. But it kind of falls into, this is everything that we designed our marketplace to be. So we'll just go through the table of contents, speaker intro, just a brief intro to the distressed debt market and CRE market. How and where to source the bank notes. That's probably everyone's hardest part right now. And I know, because that's been my hardest part as we are coming out of a record low NPL in an overly regulated market here. And then how to pitch investors, which I'm not a pro at, but people do. I guess I am a pro. People do pay me to help them pitch investors. I never thought of it like that, but we usually run cash only, so that's a different story. And then how to get them closed. That is the toughest part. Whenever we get something under contract, it always reminds me of that scene from Jaws where it's like, we're gonna need a bigger boat, because these things, they're tough to pull in. So I'm sure you guys have all been there, whether you're a lender or not. So here we go. Here's the introduction and background just on me, right? Who the hell am I? Why the hell should you listen to me? What the hell do I know, right? Best way to get to know a man, you can walk a mile in his shoes, but online is probably a little bit difficult. So let's look at me on LinkedIn, right? And guys, I'm also putting this up here for everyone else to take note. I know that LinkedIn's really huge. I'm a big believer in it. You should be trying to optimize, especially if you're a broker or lender and you're looking to either pivot more into doing loan sales. You should try to optimize your LinkedIn profile for that, as well as your website or anything like this. For instance, I've got, loan sale advisor, right? Because no one cares about who you are. They just want to know, what can you do for me? So I can sell your loans, and I love emojis. Boomers, might punch you in the arm a little bit about it and say you're silly or whatever, but it works. It catches people's eyes, especially when they're just scrolling all day through the phone. So experience right now, I don't even think this is public right now, the Xchange.loans. I just made this title up, which is the great part of starting your own loan sale stuff. You kind of get to make stuff up as you go along sometimes, especially as you found new companies and stuff like that, especially if you're tech like we are. And then, for the last 5 years, and this is sort of where we've been field testing, everything that we've been doing for XL or Xchange.loans. I've been the founder and principal with my co-founder, Andre Quadrado at Rhenium Capital. That's basically what we did, or what we started, and just focused on loan sale advisory. We did commercial brokerage and consulting, because you guys probably know, just like we do, whenever, and I'm sure it seems like you guys have a lot of like real American entrepreneurs and families who are, some are doing this part-time, some are doing this full-time, but we all know that like this is the path to creating, maintaining wealth and prosperity. And it was really exciting to see a lot of y'all and hear a lot of your stories this weekend. It was very encouraging for me. We've just been, we've just been in the trenches for the past 5 years doing this stuff. So before that, we were at auction.com. We started at auction.com back in 2012. I just looked. I would have had to think about it if I didn't see it right there. Back on South Beach when it was just a little startup, little tech startup out of a small company called L&R, which is now L&R Starwood, Barry Sternlicht. You know those guys, which they just relocated their offices from New York to South Beach, was a great thing. We started our own division. My co-founder for Renium and Exchange, I believe he's listening. If he's in the chat, he can say something. I can't see the chat right now. Yeah, so we started there. We started valuation and advisory platform or department within Auction.com, where we basically helped all the, everybody there price out and figure out how to sell these assets online. Hopefully for more, right? So we saw about 10,000 deals come across our trading desk that we ran. We helped with Auction.com finance, which we'll get to later, and how that's helping us in the SFR market now. And we learned a lot from there, how to run a tech firm and how to build your tech and everything right from the ground up. And most importantly, what your customers want. So we think we're ahead of the curve. Before that, ING, U.S. Investment Management, which is now Voya Financial, managed a pretty big portfolio there. Trammell Crow and Florida State, which I've got my Seminole shirt on right now, and tons of endorsements. So I am a real person. I think I know what I'm doing. I every day I learn more.
Don't we all, Mike?
Sometimes 10,000 deals. It's like I'm pretty sure we saw it all, but every time my phone will ring and I'll hear something I never heard before. We just had a portfolio sale, some SFR for bridge lender, hard money bridge lender out of Texas. We 3 of them of the homes, fix and flips, were raised. They were just lots, and we found out about it while we were marketing it. So I was like, well, I guess I'm not getting paid on this one, huh? So here's intro and background. Here's our past clients, primarily as Renium, and we're lining some of these clients we're working with now to get everything onboarded for Xchange.loans. So we have deals for you guys. Banks, mostly community and regional banks, which is really important for you guys. Those are going to be great leads for you. Private equity firms, investors, large regional banks, as well as national banks and servicers, and more investment groups. And here's some of the typical assets we see. It's been all scratch and dent, which is weird because I'm looking at the past, like we're at. I think this is pretty much 0 hour for if you're in the note biz. Get ready, hold fast, man. It's gonna get wild, y'all. So here's what we did before. This industrial warehouse, straight commercial. Typically a CRE, non-owner occupied, right? Because the owner isn't gonna be living in there. This is a hotel, independent franchise hotels. Hotels are gonna be having a great need for equity, we'll say, because I want to be neutral in my perspective on where things can go. SFR portfolios. This was an REO one. Beautiful portfolio. I wish I hadn't put all my money into building software for a marketplace when I saw this one, and the guy closed really quick. And here we have some. This was some land right off of I-5, out of, I believe, Seattle, Tacoma, or Portland, or somewhere around there. Developed, supposed to be a self-storage deal, never worked out, and that's that. We did get paid on it though, so that's a good one. Okay, so the distressed debt market. First things first, when we start, we want to get right into a distressed debt market. Like before we get in, right? Why is this deal hot? Why is this something we want? We got to understand what it is in the broader sense. That's why I want to step back and be like, well, what market do they come from? What birthed this distressed debt market? And that is the real estate debt market, which is, anyone feel free to chime in here, but in the U.S. it is the largest, or one of the largest asset classes that, most of us actually participate in, and everybody's a real estate investor in some sense or in some regards, right? Whether you lease a high rise, in Fort Lauderdale, where you got to work from home because you're in a quarantine, or whether you own one of these unflagged hotels that we just sold, right? So here's just kind of the general breakdown of the commercial capital markets, debt markets, right? Overall market, and I had to add this up myself since it's a little opaque in some regards. It's about 15.8 trillion as of fourth quarter 2019, which that number is absolutely higher now. CRE, that's overall mortgage debt. That's including everyone's homes, 1 to 4 family. That's everything. everything that we have knowledge of in the U.S. 15.8 trillion as of end of 2019. CRE debt was 3.6 trillion. That's not all of it because anyone can write a mortgage and record it. Some counties don't even have online public records yet. So there's obviously more out there, but that is CRE owner occupied, non-owner occupied, SFR from what I could find, which is actually single family rental, not single family residential. You guys got to call me out on that. Which I don't know, wish I knew how to have the chat screen up here, but I'll assume Scott will flag me. Just blow the whistle and throw the flag if you need to. We can backtrack. So yeah, CRE non-owner occupied, CRE owner occupied, SFR as in single family rental, typically 4 units or more, multifamily, and acquisition, development, and construction, which are ADC loans. From banks, from life codes, from Fannie Freddie, from what we know of the private mortgage market as well. That's the best number I could compile from Mortgage Bankers Association, bank reg data, all that good stuff. Feel free to chime in. And then there's this really interesting one, which I think a lot of your users would be interested in, because I'm sure some of them hold are the lender in or hold debt on some of the, when they want to get out, they're the lender and it wasn't default or anything like that, or they sold the note themselves to seller finance mortgages. That's about a $25.9 billion size market, and we've got a great way for all y'all to sell that as well. Oh, right here. It's right here. Yeah, see, I've run through this a little bit. And then the bank NPLs, which is what everybody wants to know about. Yeah, so this was as of 4Q 2019. We still don't have all the numbers in for 2020. We do have almost all of them in. They haven't changed much. And there's a lot of reasons for that, primarily because of all the moratoriums and automatic extensions forbearance, and because they got to file late, which they just started. They just handed them in last week. They were due, which isn't normal. It's an extra 30-day. And if you guys think the BLS numbers are deserve a little extra scrutiny, I haven't even looked into the Q1 numbers, just perusing, because I know that's not where the hit is going to occur. So if you're looking, the blood isn't in the water yet, but that the buzzards are circling for sure. So to my fellow buzzards, we'll go to the next slide here. Okay, the distressed debt market. So that was kind of the overall large market, and now what is distressed debt? As a mortgage become distressed? Well, I look at it through the primary life cycles of the mortgage, right? When a mortgage is, originated, what happens, right? We birth a new debt into our economy, right? What happens? Oh, this one says 7 hours. Yeah, that shouldn't. Uh-oh. Anyway, so small mistake, sorry. So all loans, once they're originated, typically start out as performing, which right now there's even case studies on that, about what is performing status and whatnot, right? Most mortgages, typically 98% and greater, are in performing status. Means they're paying according to plan or as promised per the promissory note. There's been no material breach in contract, no material defaults or technical defaults. The loan hasn't come due yet. Everything's fine. The lender and the mortgagor, are just, they're great. Just got done a great closing. Everyone's happy. You got your new property and everything. Okay. Then something bad happens, like, I don't know, a pandemic, which is wild. And then, oh man, this is hard to get through, which is wild. So it's subperforming typically begins when something goes awry and there is a deficiency in the performance of the borrower's performance as promised, right? Typically, what everyone thinks of is he's past due, hasn't paid. Typically, plus 30 days past due, right? If you're less 30 days, then you're usually within the automatic grace period. You're just late, right? Which that's more about a credit thing and not so much of the actual performance of the mortgage or what you would designate it as. So performing is always a bit of a grayscale, because there's different statuses that it's a gray area. As you can be in technical default, right? If a borrower commits felony, he now trips typically bad boy acts, or what's called recourse, guarantor or guarantee language. Says you can't commit a felony or file bankruptcy, all this good stuff. So technically, you are in technical default. maybe someone considers that, subperforming or not, right? It's technicality. So non-performing. So this is where it starts to get interesting. It should be, see, this all got moved around when I printed it off a PDF. Son of a gun.
You're good, brother. Don't worry about it. I mean,
Sorry, man. I'm a stickler for these details. This does not pass this does not pass the litmus test for me. But I haven't been an analyst for a while because I've been, I've been a LinkedIn mole these last 2 years. So typically non-performing is plus 90 days past due. The loan is non-performing status, NPL. You guys are more focused on NPNs, which typically means it is a residential in nature. NPL typically, or as far as I can tell, because this is still, gray area, gray markets, NPL typically means commercial loan, right? That's how I like to differentiate it. There's no official status, but that's what I've, deduced in my, I've been doing this since 2007, whenever we had that blizzard in Atlanta a long time ago. I've been doing this 2007, 2008, and this is best that I can tell. So that's when the lender has the ability, they're going to hit them with a default notice. Like, you are in hard default, you are 90 days past due, where's my money, right? To your guys who are investors on the phone. So that's what's really going, and that's when and that's also when the bank will typically convert it onto their non-performing loan versus the 30 to 90 days past due, or non-accrual status. Like, non-accrual and NPLs are a bit trickier. Now, I'm not a bank expert, but I've wrangled a banker or two in my days. So, okay, so from there you can hit them with non-performing loan, and that could be a zombie loan on the balance sheet forever. They just want to take it, extend, pretend, modify, try to work out a DPO. That's right before they go to the next step, which is litigation. But that non-performing status and the sub-performing status, no one really knows where anything is right now. That's why these books, they're I saw the first reports, and it was increased a little bit. I don't think we've hit the full brunt of it, but I haven't researched enough about how they have been qualifying this stuff. So, I am right there.
I don't know if you're familiar with Bauer Financial, but I spoke with them a couple of weeks ago, and the banks that file the quarterly reports to the FDIC, they were actually supposed to have it in by May, but they pushed that out to the middle of June, and those reports for first quarter aren't going to be ready for another couple of weeks. So that's why I think the numbers haven't changed that much, because they've given people more time to figure out where they're at on the banking side. So come July, I think we're going to see a big uptake, especially for the second quarter, obviously in the first quarter.
Agreed. Once they assuming that they submit the call reports in July, right?
Yeah.
We can't assume anything. The only thing we can assume at this point is someone is going to write a check at some point yeah, right? And well, I want to say it's not me, but if you're a business owner and you're a responsible American, it is going to be us. So anyway, let's keep moving forward here. So there's that mess. So then we go to foreclosure, right? The lender has engaged counsel and is starting the foreclosure process. Judicial versus non-judicial. Obviously, every state is different, and that's the state code or state law, and then there's the jurisdictional or county or wherever you would have to go to foreclose. Typically the county. It's also how that county operates, and we're seeing why this is important, particularly now. And there's so much data out there, we can't even keep up with it. I don't know about you guys, but I've barely been sleeping. And just glued to I'm a data junkie by my natural inclination here. But so it matters now because if you're seeing, and let me just let me finish with judicial, and then we'll tie this whole thing together here. So judicial versus non-judicial, right? Do I have to go to a judge and a jury, and do we have to go have this long out process? What is the judicial foreclosure process? And then versus non-judicial, which is typically just easier to get your title back and to get a decision, render a decision from the court, right? So that's that. Once you foreclose and the lender takes back title, all right, now it becomes OREO. And that's a question we can say, hey, was it REO or OREO, right? And here's what I figured out, or at least how I go by it. OREO is other real estate owned for banks and typically other lenders specifically, who will typically, or as a normal procedure of their business operations, will hold real estate, right? So that is real estate REO. If you've ever been a borrower, or if you've ever been a lender or mortgage broker, it'll say REO sheet, right? Real estate owned. So if you own real estate in the normal course of business, and you're not a bank, what the hell are you buying notes for? So it's OREO for banks for the accounting, technical, legal definition, other real estate owned, because they weren't supposed to own it. Real estate owned is their bank branches, their offices, et cetera, et cetera, et cetera. So when they take it back, it's OREO, or they just wind up by it somehow. So how is this all tied together? That is the big question right now. And it is, I've been in this business for a while, man, and this is exactly why I got in this stuff, because we are, man, wow. I'm usually drinking at 6:20, but I know y'all Central Time, and probably some good, good Midwestern folk out there, in Austin, Texas too. So, what's performing, what's not right now? We don't really, we're figuring it out. It's a big issue, and we can go back to. I want to get through the slides and open up for questions, but we don't have an accurate accounting. We've got a pretty decent idea, but we don't have an accurate accounting because everyone is reacting to this current course of events as best as possible, and everyone is involved now. And things are different county to county, city to city, state to state, and nationwide, with lender to lender and different property rights. For instance, we know that Fannie and Freddie are going to get bailed out, right? We all know this. Banks are getting bailed out, and business owners are getting bailed out for once with Triple P, right? Private lenders. We had a very large increase in private lending over this last upcycle, and all those guys out of the market, more than half of them out, gone, and they're pivoting. Why continue to make loans with baloney rates, and rates are probably that is your clear indicator that values are not very likely to increase, since they are all going to the distress mode, or pivoting, making their pivot into lender mode to buying loans, going to be a lender through other means, right? As well, brokers and investors should be having their eye on that as well, because it is a lot different. It won't last forever, let's hope, right? And as the old adage goes, when there's blood on the streets by real estate, I hope that doesn't offend anybody. But the reason why we say that is because you cannot hightail out of there and just leave your property. Someone's got to stay in there. So you guys are kind of like the when the mortgage bomb goes off this time, we're the people running towards the blast. Okay, so that's our job. I take my job, my role in this market very seriously, and performing. I don't know what's performing, what's not. Got a pretty good handle on it, but yeah, we don't want to go to. We can go down that rabbit hole further or later. Subperforming. Almost everybody's subperforming now, man. People lost their jobs. Gonna have record BKs. Lenders can't even evict. Securitizers, they're making the loans. The securitizers, people like Quicken Loans, people like doing Fannie Freddie DUS, right? And they're going to get that government approval or securitize it, but they fund it and then they wait to offer their securitization, and people just stop paying rents. So what happens there, right? So that's subperforming. Non-performing, we just hit our first 90 days. We just hit our first 90 days, and this is going to continue to play out in 90-day trends, but we just hit our first 90 days, and there's been automatic forbearances and moratoriums on foreclosures and evictions. So, who's performing, who's not? I put the APB out there. I've been sounding the alarm for the last year for lenders who sell any non-performing loans that they already have on their balance sheet, because the next phase of the cycle is coming. Which, let me get a little preview here. State preview here. I can't. I'm no good at
Hey, Mike, we don't have to go into the foreclosure default aspect of that.
Okay, cool. Focus on NPLs. Cool. I'm gonna go.
Yeah, well, we just had an attorney on talk for about the foreclosure.
I'm the last guy. Okay, cool. I'm sure. Did he sound a little little deer in headlights? Maybe, I assume. Maybe. Okay, so. Right, how big is this market? So focusing specifically on banks, which has really good info. This is all from bankregdata.com. Bankregdata.com. This is the amalgamation of all of the call report and regulatory reporting for all U.S. banks who hold certificates in the U.S. as well as Guam, Puerto Rico, all that good stuff. So, you know, CRE is really important part of a bank's balance sheet. It's typically the largest asset class on their balance sheet, which, assets equals liabilities plus equity. Your loan is a liability to you. It is an asset on the other side of the transaction for the bank, for the lender. So, okay, where to start here? So you can see here, and specifically, I think the next one. So this overall bank size. Yeah, right now total assets. We do have the 2020 Q1 numbers, but they haven't all been reported. So I don't know enough about those numbers. I'm assuming there's just banks who haven't submitted and they're not included here. But we had a pretty good spike to $20.25 trillion in assets as of 2020 Q1 and likely higher. So that's, hold your seats. It's pretty big. It's the iceberg, right? So here is the breakdown on everything that's on the bank's balance sheet as of this reporting date, right? Specifically for real estate. This was just total assets. This is specifically for real estate loans. Okay, CNI, commercial industrial, which wow, usually you see 1 to 4 family first liens on there. That's interesting. I pulled this all very recently. So CRE non-owner occupied and CRE owner occupied, that's typically what we do, but you have all of their other loans as well, foreign government loans, etc. Asset size, who has, which banks have what and how are they performing, right? So you see the 4 large banks, right, obviously dominate the entire field, right, which we've had this massive consolidation of banks over the past few decades. And non-performing, they are doing great, 0.92. That's great. You want 1% or less is optimal. 2% is pretty normal. Once you get over that, like 1 and 2%, that's when you're like, okay, something's going on. And then you'll see here, and why it's important to you guys, this is most of your banks right here, right? These small banks, these I call it the under 1 billion in assets under management, right? 999 million to all the way, and those are the guys who have the toughest time with CRE. Making the loans, and they don't typically they need help. They need your help selling these loans and either getting consulting or even help managing REO. Those are the folks you guys would probably want to focus on, as you can usually get a hold of somebody there and there's not a huge chain of command, and you may even know them because they're usually in your community or they're within a 1-day drive. And then same thing here. They also have typically the higher levels of non-performers, the 5 to 49 billion. Man, this is blown up big. It didn't look that big earlier. They also have, once you go over 1%, you probably want to go take a look at, those folks. But you guys are probably going to want to focus on 1 billion in assets under management and lower. Oh well, we had a whole deal on why it's important and stuff. Okay, bank CRE exposure. So we saw. Total CRE loans right here, right? That is just under 2 trillion. It's pretty large just for the banks, right? I think we had that one in the auto was about 5 trillion or something like that. Which was that? Yeah, the total CRE debt was 3.6 trillion. So this is a very significant portion of CRE loans, and you can see here concentration loan above or what sort of banks, right? So you can see here. Your community banks and your regional banks have the most, are going to have the most loans in your area or the most CRE loans. Here's the real important chart here, okay? This is probably what we're going to, so that's kind of who you want to focus on when you're looking to source bank loans. Focus on, what is it? Don't go chasing waterfalls. Stick to the rivers and the streams that you're used to, especially, and here's why. We're kind of that a catalyzing moment here where, oh man, this got cut off. Yeah, okay, sorry. So if you see here, Green Street Advisors, they're another really great source for everything CRE, especially Main Street CRE. They have this thing called the CPPI, Commercial Property Price Index. Commercial Property Price Index, CPPI, which is way more relevant to us than the CPI, and it's not nearly as fabricated, which is great, so you can rely on it. They noticed a dip. They've got a pretty healthy dip right there, right on time for what was yield curve inversion, which the Fed is looking to actively manipulate now. And you'll see here, 100 is basically that sweet spot, right, where we were kind of like that peak, 2006, right before 2007, after the consecutive bank rate increases by Ben Bernanke, helicopter money, all that good stuff, and then the low, 63.3. So that is what they're comparing it to. So we were at about 130, almost 140% of the last cycle, right? With a ton of loans on banks. So it went pretty high, and they're already seeing or basically forecasting, right? Because there hasn't been as many trades. What the best that they can gather, or the best data they can gather, that is where they're measuring it, and they are very accurate. And this is a significant dip already, all things considered. Okay. Why? So that's property values. That's when people are trading property. That isn't note values. That isn't what is that. That's just overall commercial property price index. Okay. Doesn't mean for specific markets or specific asset classes, etc. They have all that data too. Check them out. Green Street Advisors. Why is the value and the overall pricing index of commercial properties relevant to sourcing bank CRE notes? LTV, loan to value, right? That is the key element there, and also why these things are why these things are kind of happening right now, right? It's timing is everything. Loan sales tend to increase during the recession, right? That's why we're all on this chat. That's why what we've been working on for the past few years. And real estate is very cyclical, right? We came out of the recovery. We're on a 10-year hot track here, hot streak here, hot-handed dice, right? Recovery, right? Declining vacancy. We didn't have any new construction for a while, and the loan terms were very conservative, right? That makes it harder for people to, especially investors, to meet the demand side of the market because you have all these constraints on supply, and specifically with financing, right? Not many people buy all cash, and we don't stick in it for long because it's a very illiquid asset. So we want to go use our cash for other things. And then we hit the expansion phase. 2012 is really when we started expanding. And we have been in a healthy expansion phase. I would say 2012, 2014 was pretty good. That's when things really started ticking up. And I would say 2017 is when it's like, okay, it's getting a little aggressive here, fellas. So declining vacancy, when everything's just humming along, new construction. And here is the deal, and here's why it's an issue. It's very illiquid for a reason. Real estate, I mean, you're literally moving mountains in some regards, right? You are getting approvals. It's political. It's financial. Banks are over-regulated. You got to get investors on board. Anyone who's taking time to close the deal, that's after it's already built and everything. So for the expanding demand of the consumer economy to be met with the equilibrium of supply for the demand is instant, right? And once it gets that kick, that financing, it becomes activated, right? Actionable, right? Everyone's got their loans, and they want to go buy real estate. They want to go lease a new apartment. They want to open a new business. They need to house that that idea, whether it's a family or a business or what have you. If you want to build a real estate, it takes a long time. Typical delivery times, like at least minimum 1 year, maybe 6 months for a house, up to 5 years if you're trying to build a skyscraper. And if you're Amazon trying to build a headquarters in New York, it's going to take you a little longer, right? So that's why we have it's always real estate supply is almost always going to lag demand. So they've got to build it, and they will come, right? And then they get ahead of it and everything, and that leads to hyper supply when people start building and they don't have things under contract. Apartments, you're almost always building spec. You're basing on the demand, but apartments typically take 2 to 3 years to deliver. So that's why Miami, they've got more apartments than they know what to do with. So we are here. We are at the inflection point. In certain markets, we are just past the inflection point in certain markets, and then we got hit with this right at perfect timing, which was crazy, which we are in for the recession. We don't know. Everyone said it was going to be a quick recovery. Now it's not. I think no matter what, if you are in distressed debt, whether you're selling or consulting or managing or investing, you are going to be busy for the next 2 to 3 years, potentially longer, right? Because I think there's also a larger trend here going on, but we don't know what's going to happen. And anyone who says they do, whatever, right? Okay. Sourcing bank CRE notes. So we can talk just a little bit more about, just kind of the idea behind it. That's more of the, I probably should start off with this because it's less technical. but here's sort of, kind of the mindset you're going to have, right? Okay, first of all, real estate debt is a very significant cornerstone of the capital markets, and it's almost involved in every real estate transaction. So, and the whole thing about sourcing it is, well, where are the distressed ones, right? You see buildings and you're constantly surrounded by properties. Some can be open, some can be closed, vacant, in good shape, etc. How do you find the debt and what makes it a good time to sort of sell it, right? And this is sort of what you guys are looking for, and what you need to get ahead of here, right? Number one, it's cyclical. This is happening. I don't know what you guys are listening to, and I can't wait to hear your feedback, but this is happening. We're oversupplied. The market's changing, and the Fed is also backed us into a corner. So it's different, you know. I like the saying CRE is cyclical. This time is different. The main things I can give to you guys on what's going to be different in this cycle versus the last cycle, right? Last cycle, CMBS deals were like, they were the prom queen of the distressed market last cycle. And I would say, what else was really popular? Online auctions, right? I worked for one, right? Probably probably the most popular of the online, or what we would call the wholesalers, right? So if you think you're just going to go back on to 10x or auction.com or DebtX and find, oh man, where are all the CMBS deals? It's not going to happen like that this time. At least I don't expect it to. And the reason being is because they were hit with a lot of different regulations. We can get more into it, but I just want to touch base on that. Why is this cycle going to be different? They're facing different regulations. The chatter, I'm into, I'm a data junkie. I talk to people about this stuff every day. A lot of good connects and everything. All the special servicers last cycle, they kind of had free reign. That's why LNR, Torchlight, Rialto, all those guys, they did a really good job. But LNR owned a piece, or was an initial, owned, you guys probably know, it was in the sale. They sold their interest a while ago for like $1 billion in auction.com. They were the special servicer on CMBS assets while also owning the disposition platform where they were able to charge a big fee. So they changed that this time around, and now special servicers are going to be more focused on servicing, right? Because they're not going to be so forward with convincing the bondholder to sell because they don't get paid a fee upon the disposition. So in terms of them keeping their coffers, they're going to look to follow more like banks, and they're going to be marking it down progressively. Banks, last time, they got way overextended on speculative real estate, primarily residential and land, and commercial as well, because the way the credit underwrites, or bank credit underwrites for commercial, is totally different than the way I underwrote when I was at Voya, when we were an actual balance sheet lender. Everyone says they were balance sheet lenders, and most of them aren't. We were actual balance sheet lenders. So banks and balance sheet lenders and bridge lenders and funds all underwrite differently. Banks didn't have nearly as much reserves, and remember the Dodd-Frank Act, which required like Basel compliance and all that stuff for CMBS. They have a lot more reserves than they did last time going into this, and they did not get as overextended in speculative and more riskier assets. With that said, this time is different because you came in foreclosure in some states, and I think they are going to wait. Hold on, I'm probably taking too long, but I think they're going to wait and mark it down along with CMBS, and you're going to have more of an extend and pretend, modifications, DPOs, and everything. So if you're a consultant in this business, you can make some really good money, and probably for a couple years, so you don't have to go straight for the loan sales. I don't consult. I do it we do it sometimes privately for some of our good colleagues or friends, but it's just we can't trade our time for money all the time. But yes, there's good ways to consult and bad ways to consult. We can get to that later if you guys need advice on that. So brokers, investors, you must pivot for the distressed opportunities. This is about focusing on banks. You guys are probably want to go to focus on rental properties and the properties that you see in your area, or the properties that you're familiar with, right? If you're a hospitality broker for the last 25 years, don't try to get involved in foreign asset loan sales or student loan debt sales. Stick to what you know, what you're familiar with, because the note sale adds a whole level of complication and technical expertise, as well as a different, you're going to need different networks, right? Because you're same buyers who buy finance aren't going to be the same guys that you go to. So you got to pivot, and you got to know what sort of opportunities to look for. The good news, man, I've never seen more demand in my life or more cash for these assets. Right now, some of the buyers are kind of waiting on the sidelines because a lot of the buyers were former lenders and they know they got to wait a little longer for the fruit to get a little bit more ripe on the tree. That's why, and we don't have all these great numbers. Everyone kind of knows it's coming and everyone's getting ready. They're getting ready in the trenches to go to battle here, and hopefully good deals will be won and lost amongst many, right? And here's the number one thing with and I noticed this too when I first transitioned from a lender to a commercial mortgage broker, for BBT, Dust Lender, all that good stuff. I was a broker. I leased, I did development, and I sold properties, warehouses for Trammell Crow down in Tampa. Same people from Tampa here. I love you guys. I love it out there. And then I went into lending for a balance sheet lender for Lifeco, conservative Lifeco, ING. And then I went to become a mortgage broker, got involved on the online auctions, and now I ran my own loan sale advisory, and now I'm becoming a marketplace. So very healthy development here. The difference in mindset from the brokerage side of the business to the capital markets and loan sale advisory side of the business, there's a lot of differences. So if you want to do this and you want to get involved as a consultant or loan sale advisor, you've got to make sure you know how to differentiate yourself. Put in loan sale advisor, or put in distressed loan consultant, right? Or distressed asset investor, right? Makes all the difference, and it's very specific. I specifically, and you guys are gonna think I'm crazy, I got rid of my real estate license because I was sick and tired of people asking me for it. Oh, well, do you need to be a broker? What's your broker license? I couldn't find you. And oh, so you're the broker. I'm like, I am not a broker. I'm a loan sale advisor. So please don't call me broker. My partner Andre, he's the broker. He still has the license, and he also runs our trading desk. All I do is source and close on the marketing agreement, right, for the banks. So number one thing, lenders are never in a rush to call you back, right? So on the loan side, you can't be in a rush. You can't be a broker chase. You can't be a dog chase cars, because I live that life. It will get you nowhere here, and you have to make sure you have this thing lined up right, or you will not get signed up. You will not get signed up for the right price. You will not find the right buyers, and you will not close, and you will not get paid. Simple as that. So you got to do certain things right, and we can get more into details about what you guys need to do, especially if you're having trouble. I want to hear about it. All right, the first thing you can do is get on LinkedIn for sourcing bank notes. Man, a lot of those bankers are out there, especially those regional to the mid-sized banks. Those 1 billion banks, they're out there. The executives, you're not going to find them on LinkedIn with their face there, with their $1 million smile, right? Like most brokers are, like we all are. Because they have the money, everybody wants to get a hold of them, and they have to go make loans and go manage their business. So you want to look for, let's see here, do I have it on here? Yes. So you want to look for, let's start down here, bottom right here, targeting. So you want to target bank asset managers. If I give you one keyword on who to target, it is asset manager, okay? Or asset man, right? When you're looking in keyword searches, right? Because there are asset managers, special asset managers, special assets groups. There's tons of different ways. Get known with the nomenclature and search for that. Then you also want to look for, and there's a reason for this, right? There's a method to my madness, I promise. 1 billion and less, they're typically not going to have personnel and resources specifically dedicated to asset or special asset managers. You just don't see enough of it. They might be an asset manager, but special assets, very rare for them to have their own department at that size, but it all depends. Because every bank and every deal is different, every market's different, right? So I always go for the asset manager. I usually go for senior asset manager, or if I can, just asset manager. Add them on your LinkedIn, like their stuff, be active, right? And just find them. Build up your leads list. And then execs, bank execs, especially for that $500 million to 1 billion, those are usually going to be the guys who are your decision makers. So if you can call them or start with them, like, hey, I want to buy, I want to sell, I want to help you consult, just be very direct with them. Approaching them on LinkedIn is key, but typically look for asset managers and SVP or up. Don't waste your time with it. I don't want to say waste your time, because networking is always good, and you can helps just get more ingrained with their culture and who they are, because I care a lot about these bankers and their communities that they serve. But those are your decision makers. So don't negotiate with someone who's not a decision maker. We'll say, for all my boiler room fans here. Okay, security is key, and this is why LinkedIn is really important. Okay, and I hope I'm not rambling. I hope this is all meaningful because I'm trying to stay focused here, but there's a lot to cover. Security is the number one threat and risk to banks. Number one, spamming and phishing. That's how the DNC or whatever got hacked, right? The email, Russia collusion, all that good stuff. I don't want to get political, but it's hacking is a big deal. Cybersecurity is even more important than ever before. So how do you reach out to bankers if they don't want to open emails from people they don't know, and their spam filters are very high? And I don't want to get into that. How you can trick past the spam filters and things like that. That's why LinkedIn's good, especially if you want to send them documents. Don't ever send them a document over email if they haven't have you approved already. Don't ever do it. It's a bad idea. I've done it, so that's why I'm no. So LinkedIn is that third-party service because it's not Facebook, it's not Instagram where you could be anybody. LinkedIn, you could still be, it's a little tricky, but they typically know, and if they can look up your firm, and you got to have your network, it's hard to fake a good profile and a good conversation on LinkedIn, and it is filtered, and there's a track record and everything, and they're not exposing, because they can use it on their phone or their home, they're not exposing their networks to risk using LinkedIn because it's not on their bank network. So they can look through their personal account, and they can also have it on a personal account as well, and it's a good way for them to basically get to know you and get in front of them without tripping off their spam filters or anything like that. Okay. Automation. There's also a ton of ways you can increase your scale and approach and your ability to source leads on LinkedIn, specifically looking for banks, right? So, I don't want to recommend any specific one. There's good ones, there's bad ones. Make sure you're with a name you can trust. Make sure you build out your tech stack as well to try to automate your reach as much as possible. Because I am the only one reaching out to banks here. My partner runs the trading platform and a lot of back end stuff. I am the only guy sourcing us deals. So, and I think we sold 48 last year. Dre, if you're on there, chime in on the chat. How many did we sell? Let's focus on that. Not how many do we sign up and waste our time on. So you can automate, and you're going to want to automate that. Speak banker. That is probably the part you guys are going to have the big. You don't want to speak broker. If you come across a broker, they're going to treat you like one, and they don't want to hear it. They have their brokers they like to talk to. If they want to talk to a broker on a note sale, they will. Okay, and they already got the brokers. If you want to go sell REO, cool, you're a broker. If you want to do note sales or you want to buy the notes, you have got to speak banker. Do your research. Find out, where are they located? What's on their balance sheet if you can find it out. Do a media search, find out, did they merge? Did they recently get bought out? You can also, when you type up their name, you can find out if they have foreclosure filings in certain counties, right? Do your research to try to kind of focus on their needs, their goals, and what's more important to them. Because no one wants to hear about you, they only hear about them, right? Speaking of which, sorry for the long intro earlier, but in a high level touch or high level outreach goes a long way. It's totally different when you send out 100 messages on LinkedIn. Hey, I came across your profile and thought we should, discuss synergies and possibly networking and how we can do business and call me for a free trial. No one wants to hear that. It's garbage. You can always do that, right? The mid touch or the low touch, right? The high touch is, Jim, I saw that First National Bank of Austin, or Scott, First National Bank of Austin was in the news for their contributions to the local hotels or local hospitality. Just to let you know, we are experts in hotel note consulting and advisory. Don't even hit it with the sales pitch if you want to, right? Because whenever someone hears sales, right, they always back away. We are experts in loan sale advisory specifically for hospitality loans. And I saw you had a really great portfolio. You had over 100 million in hotel notes or hospitality or whatever. And it looks like you got about 5% that are default or in past due. And I wanted to see if there was a chance for me to help you with those and find out what's giving you trouble. Right? That's a way better pitch than, hey, let's connect in synergies, right? So speak their language, know what they might want and know how you could potentially help them. If you don't know, or you can't find it, or the info is no good, and you're just like, whatever, I've gotten my reps into cold calls, all that good stuff. Just try to get a script that still speaks their language, right? Like NPLs, OREO when talking to bankers versus REO. That's a real big one that's going to give away that you're not a banker, right? Jedi mind trick here. And then targeting, we already said, focus on bank managers, execs, and overall, be active. Be active, be automated. Speak banker and know who your targets are and keep and watch on them. There's a lot of good programs for that. I don't know what your guys' personnel or resources are, but be active on social media, because now that all the market's converting, and you got to rely on your network more than ever. Your old network, talk to them. Talk to your clients. Is this back on? Check. I think so. I can hear it. It sounds like it is. Turn this off. Call me on a Sunday. Speak to your clients, speak to your buyers, speak to your sellers, know what's going on in your market, and be active within it and work your old network. You're probably going to have to also not just look for banks, but you might also have to look for buyers and investors. So it's both sides here, because same guys that were closing your deals last year aren't going to be the same ones here. And most loan sales, if you want to make sure you get it done, you're going to want to close all cash. So that's another one. So I hope, how are we doing on time here? I'm going to.
You got about 10 minutes left, Mike. About 10 minutes.
Cool. Awesome. All right. Sourcing bank CRE notes, right? Okay. So here's the shameless plug. You can also just check out Xchange.loans. We are the only online marketplace where anyone can view the listings, and all of the listings are verified. All of the buyers and the sellers are verified, but everybody has access. So it's easy access, it's secure. We're using some of the same technology that the banks use to secure all of your confidential information, and we provide everything right up front. There is no auctions, because everyone's got auction fatigue. Auctions suck, and also for banks, they cannot control it goes the highest bidder in an auction. When you do an open call for offers, it's an open call for offers, and we can help, or the bank can decide, or you as a broker on our platform can help advise them on what is the best offer, closing time, deposit down, hard money, refundable, etc., and who it is we are selling this asset to in our community to recapitalize this asset, this community, and this bank. So it gives you a much greater deal of control than online auctions. Online auctions are good for some things, but also primarily it gives us price discovery, which is your key. Is price discovery, certainty of closing or of execution, is your key value proposition as a loan sale advisor, as well as a consultant sometimes, right? You want to be able to execute the DPO, execute the deed in lieu, execute the modification. So it gives us a greater deal for no auctions. And then verified, like I said, everything's verified. I don't want to keep talking about my stuff because I want to give it, but we're going to be a source. We're just starting off. I think we got one live deal up there. A lot of those are dummies. I think we got one SFR portfolio. Drake can chime in more on the chat. We got about 12 that we just underwrote with pricing out to special servicers for SFR portfolios. And then we had single family rental portfolios. And then we've got about another 12 or 15 in the pipeline coming up. So it's going to be a busy summer, but that's just going to be the start of it. All right, so pitching investors is probably what I do and historically have done the least of, because I've always been all cash, or we always deal with all cash. But find the asset first, find the NPL asset first, or at least have a really good idea of what you're getting into, right? You're like, hey, like this is our track record, right? If you don't have an asset that's ready to close on, because that's the first thing the investors are going to want to know when you're raising capital, or a lender if you're looking to raise capital, right? Not in the form of equity, in the form of debt. Is to, what am I getting? What are you pitching me, man? What does it look like? It's a property. It's a note. What's going on with it? Is it in foreclosure? Is it default? How much do they want, right? So it's easier if you know that, if you can source the asset and get a general inclination of where you should be on pricing, and also have your track record, right? So source the asset first, and have it be something that's in your wheelhouse. Don't get involved, especially if you've never been in a loan. If you've never bought a loan before or had anyone invest, you never taken a property back, or you never managed that property, try to stick to what you know. Stick to the rivers and the streams that you used to, right? Target and approach. So I love the hotel thing because hotels are very specific, right? So if I'm a hotel broker, now I'm a hotel advisor, right? A loan sale advisor. I found a hotel asset, right? And I got a good idea of price, and I got all the due diligence, right? Who's going to want to get a piece of the action with me, and who's going to trust me? So if you don't go to try to sell it to another bank, right? And don't ask the bank for a note that you're buying it from. Whatever you do, don't ask them for the loan, because that just everything is wrong with that, and I can't even get it. We could do a whole hour and a half on that. But know who you think, have a mindset of who you're going to approach with this, right? And then what your proposition is going to be. Paperwork, have all your due diligence. When they say, well, what's the payment history? Have it. How far along are we in foreclosure? Do we have clean title? Get as much due diligence and paperwork up front. Also, have your PPM, right? Your private placement memorandum. Have your organizational docs if you can, or your to-be formed entity. Have your agreements. Hey, this is what's going to work. I'm going to be the managing partner. You're going to be managing member, or just a limited partner, etc. Proof of funds. Also ask them for their proof of funds. Don't just have, hey, yeah, I'll give you $1 million or 100,000 or 10,000. Hey, man, don't accept that as a commitment without proof of funds, because you're going to need proof of funds to buy on my platform and for banks to take you serious when you come in with an offer. Here's my offer. Here's my proof of funds. Here's my investment team. Here's our org docs. We are ready to roll, and this is my offer. This is why it's going to close. You don't always have to be best on pricing to close. On the auctions, you do, but on these, and when you're dealing directly with banks or you're working in your traditional network, you don't have to be best on price. Strong closing terms go a long way when these guys decide that they want to be out. Okay, best practice, proof of funds. Proof of funds, if there's one thing, proof of funds goes above. Money talks, man. Money talks and everything else walks. You will increase your probability of success with proof of liquid funds. I cannot tell you that enough. It's the most important thing if you're looking to get investors, source deals from banks, show them proof of funds, right? And then be able to actually get your deal approved and executed and closed. Proof of funds, and then you don't have to worry about where your money's coming from. So next ones, because I think I'm right around time here. Okay, yeah, so a lot here to deal with here. Here's the actual, and this was my top 6. I keep going on and on and on, but this is what I got for you guys. Purchase sale agreement. Make sure you have a purchase sale agreement that is pre-approved by the seller and by the purchaser before they introduce them to each other. So and make sure your fee is in it, because if not, don't ever let them talk. Oh, let me just talk to them. No, don't you ever let them talk to them. Don't. Right? Buyers are liars, sellers are no tellers, and brokers are jokers if you don't have what it takes to close this stuff. So be mindful of this stuff and have it ready. Deposit. Let's go to insurable title report. What am I buying? Is my lien secure? Are there other liens? Right? If you don't have the report, and if it's not insurable prior to closing, you can pull a preliminary title report or go one that's a little bit older, but don't go into closing without knowing where your title report's coming from and having it being insurable. And there are instances where you will have deficiencies in title, and we've worked on them, we've consulted with them. They're out there, and people mess stuff up, and people will put liens. So know what you are buying and who else has a claim to this lien, because this is Wild Wild West. There's not going to be any reps and warrants, and once you close this deal, you are on your own, okay? Can't express that enough. So get insurable title before you close. Doesn't have to be first, doesn't have to be second. There can be other liens. Just know what you're buying and adjust your outlook and pricing accordingly. Deposit and escrow. If you don't have cash in escrow and a signed PSA, do you even have a deal? Do you even have a deal? How are you getting paid, right? Have the escrow, have the purchase sale agreement, be on it, have the insurable title, right? You see how this is going along here. Complete your due diligence before you go and ask everybody to sign up or ask for money. Is all your due diligence before you make your offer? Have you done all your due diligence? Important thing to note on NPLs versus REO and traditional listings is you do not get to always inspect the property. Lenders are technically, and technically it can push them into technical default, because lenders will usually have a right to inspect their collateral, right? And within proper notice, just like your manager or your owner wants to go in and check out his units and go and check out his business, right? And manage it, or an insurance inspection. You don't always get that, especially on this is strictly commercial. I don't ever deal with resi or qualifying mortgages ever. They're not always going to be friendly and let you in, right? Or it could be, if you got something with environmental contamination, you really want to go in there, right? Hey, I have tenants in there. You can't go in there. You can't disturb the tenants, right? So contact with decision makers. Make sure you have direct contact with with the highest decision maker you can get. Doesn't always work with that. Most banks, very few banks will have one decision maker. They always have their quorums and their committees and their process. So make sure you have whoever you're talking with, that's your decision maker, that's going to give you the word. You're going to have all this stuff, and you're going to be pitching the deal to them, who usually has to get approval from their committee. And there could also be there could be bondholders if you're doing something else like in CMBS, etc. So don't get caught up in the daisy chain with the buyers. It might be a fund, and they might have their investors, but. And this is why I say this: if you don't have direct contact with this person who's supposed to be the actual decision maker, or the person feeding you the decisions from the decision makers, once they don't get back in contact, when you have a note and you got an NPL for sale, everyone's hot to try, everyone's calling you. And then when it comes time to closing, start calling a little less. And then when you're in a contract, if they don't go, this is the most important thing to have on the back end. Who's watching your number six, backup buyers, backup bidders. If you don't call my phone or answer my phone call or call me, when you're supposed to close, when I'm supposed to have a contract, you got to go on to the next guy, because they're always going to be testing you and checking you, and they will retrade you in a minute if they think they are the only fish you have on the hook, because they got all cash and they want a deal, right? So that's that. Let's see here. What's the next one? Thank you, Note Camp 2020. I hope that was right on time. It looks like it's 6:59 here. It's Q&A time. This is just the general screen here. If you guys want me to share screens, I'll let Scott direct from here, but thank you for having me. I hope I didn't ramble too much. I hope that was really clear, and I'm open and really excited to hear what you guys have to say.
Yeah, so we got Andre Benji goes, particularly on commercial deals, requesting an inspection period is a non-starter, so due diligence up front is not an option, it's a requirement. Retrade on a loan sale that was approved will blacklist you from ever acquiring again. It may also blacklist you from the marketplace. Yeah, exactly, Andre.
Where's the chat here? Oh, we got 58 participants. That's pretty good. Yeah. So and then Andre. So yeah. So that's you can tell he runs the trading desk, and he's tired of fake buyers.
Yeah.
So, but for me, and it's weird because we have a how do I put this back on here? I don't know which.
Don't worry about it. I'll get you taken care of here.
Oh, I was trying to read the question, but I'll let you. I'll take all questions. Yeah. So you want to have that DD performed up front and have sort of a meeting of the mind. We've done a lot of these, and we're constantly changing how we operate and do business in our contracts and agreements. That gives you the benefit of, hey, we're under contract. Maybe it's non-refundable or refundable, right? Banks don't typically like holding on deposits, especially if a guy goes, hey, you defrauded me. I didn't know this was a loan. What do you mean? What do you mean the borrower is challenging lender's right to trial? Oh, he could foreclose bank. This guy could go bankrupt. I didn't know that. No, you got to get their okay, and it's better if you can do it on writing that, like, yes, I have reviewed all available due diligence. They know this is all they're getting. Otherwise, don't take their money. Want to make sure everyone knows what we're getting into here, because it's high risk, high reward, and there's the quick and the dead. So, and that's why having those backup buyers is so important, because if anyone flinches when you're ready to storm out of those trenches, you got to go jump and battle belly up with the next guy. Perfect. And also prevent retrade, because when your buyer falls out, because I didn't know he could you could call bankruptcy in the United States. You could file bankruptcy. You're going to go to the backup bidder. He's going to be lower, especially when you go back to him. And now you got to go get the bank to prove that again. So it gets really fussy all of a sudden. And if you're broker, you've been there a million times. So it's tougher on the note. Sorry.
All right. Cool. Well, Mike, I want to say thanks for coming on and sharing everything there today. I appreciate it so much. You guys, you enjoy the rest of your Sunday and your weekend. All right, brother?
All right, thanks for having me. Go Knowles, and get ready, y'all. And feel free to check out Xchange.loans or email me for any additional items. And please share the slides, Scott. Thanks for having me.
Thanks, man.
Thank you.
All right.